Okay, welcome everyone. A couple of you know me. My name is Anjum Sata. I'm working with the UK Versity last 8-9 years now, and I'm also teaching at University Bradford. And I'll try my best, to meet your expectation, background, ACCA, teaching MBA, the various sort of subject. And I'll try my best. If you have any question, please feel free. Always ask. Of course, is a taxation. There can be various issues, but we'll try to go through because most of you working in accounts, maybe the stuff more than me, because if you in practice, of course day in and out, you're dealing these, but we'll go through as what is really in term of the key learning outcome. That's all from my end. Okay, quick, if you can introduce each other, so it's good to know because we are starting a new module. Yes, so a couple of you new, so it's quick if you can share with each other, please, if you don't mind to. Just your name, what you do, what you done, please. Keeping in view of GDPR. If you don't want to share, is absolutely fine.
Okay, I can go first. My name is Najam. I work in investment management and got a master's degree. I've got finalist ACCA and a few other qualifications. So this is kind of really, additional one that I wanted to do. I have like exemption from pretty much all modules other than this UK taxation. So that's why I'm doing this one.
Okay, brilliant. Thank you. Thanks for sharing. Welcome. Who's next, please? If you want to quick,
Hi, I'm Dennis. Dennis, come from an insurance background, so I'm into financial reporting with an insurance company in London. My background is I've done my master MBA and I'm ACCA qualified, but ACCA is just they pulling my legs. So I thought let me just quickly come to IFA and use IFA to get a practice certificate, and I can move on with my life. So that's in short an intro of me.
Brilliant. Great. Thank you. Well done. Who's next, please? Thanks for sharing.
Yeah, my name is Jonas. I did a degree in accounting and finance. I'm ACCA part qualified, currently working in an accountancy practice. That's all really.
Okay, great. Brilliant. Thank you. Thanks for sharing. Yes, please. If anyone else want to share quick, so we can start. So a couple of you already know each other, which is okay. Welcome. We'll start. Okay, welcome everyone. So of course we are going to start new modules. Today lesson will discuss about LO1, learning outcome 1, which is about understand advanced aspect of UK taxation system. Okay, in taxation always, very well, because is the issue, finance act. Yes, which finance act you want to follow, because it's not your exam. We can say, specific, you have to follow particular exam, finance act, especially when you're doing ACCA, CMA, or any other exam where we have to look around, uh, so very specific towards your exam, external, because this is your assignment based course. Yes, so it means, it's a matter of writing your assessment and answering the key question. Those will be in your exam, in your assignment. That's the key. Okay, understand the advanced aspect of UK taxation. Of course, we just want to develop our understanding of the aim of this unit, UK taxation system. And then the key we have, is always good to look around, the current your knowledge about income, corporation, and overseas tax element, the domicile and other elements of it, and indicative content. The purpose is we look the scope of income tax. We can look around employment, self-employment, property. It can be many key, the key points there, which is But our lesson overall, we'll discuss, of course, if we look, the benefit in kind, then all others it can takes, but we'll give a bit, if you want more, we have some books available on our Moodle page. We can arrange one-to-one, or if you're really keen, we can explore more, and we can go through all the relevant points. Okay, so these are the key points which we'll go through. Of course, discussion will cover a bit, value-added tax as well. And a couple of you already may be submitting VAT return, and you're well aware of different schemes as well. Okay, so always good to when we look around, because ultimately an application of the rates, really we need a good understanding how we can apply. Of course, already personal allowance. This is slightly a bit, 1 year, 2 years old, which we are looking Finance Act 2021, 22, and you can look around 22, 23, or 23, 24. Yes, so slightly 12,570 and 12,500. Yes, so these are which we can look around. The personal allowance, of course, every year is carry on changing, and the basic rate and high rate, additional rates, all because a couple of you working in accounts, so you very well knows how the rates work. But our discussion will cover. So I included some stuff which we can look around. Of course, you know the car benefits according to the CO2 levels of the car fuel benefit, how we can claim, that can be in our discussion, company van benefits, individual saving accounts, property income, and these, all it's come under the Finance Act, which we can look around. Yes. Pension scheme, approved mileage, you already know 45 pence, 25 pence, and so on, according to this year's Finance Act. Yes, capital allowance, of course, then we can look around the asset is belong to man pool or special pool, and we can claim, the capital allowance accordingly. Of course, you're well aware of we can't claim it depreciation, but we can claim capital allowance. Yes, CO2 carbon footprint, if we have motor cars and all, that's accordingly we can claim, and some can be exempt, which we can look specific according to the question. Cash basis accounting, yes, revenue limits and so on, which will go through value added tax, different schemes we can join. Annual accounting, which flat rate, then of course, normally standard VAT return, which we do every quarter. We can inherent tax, of course, that's the big, 325,000, or if is yes, nil band rate. And then of course connected person, those we can explore more. Okay, then of course you're well aware of NI, national insurance, capital gain tax, on normal rate, and properties and higher. Yes, so which we can look around which band you falls, and then we can, of course, national insurance according to the classes. Okay. The UK tax system is, we can look around the UK tax system is professional and ethical framework. Really, we need to be follow if you're working. We can look around professional code of ethics, which those we even discuss in our corporate reporting as well, which we'll go through, and our discussion will be direct, indirect taxes, and various case laws can be. Okay, it's the tax and the guidance, the tax law, of course, Act of Parliament. We can look around various case laws, details, regulation, instrument, HMRC guidance. Of course, we can follow through HMRC website as well, which is carry on changing. So we need to be look around those. So method of operating as a business, it can be sole trader, partnership, or company, and make sure your taxation rules accordingly, which we can look around. It falls corporation tax, it falls, self-assessment. So we can look around the type of incomes. Yes. So different incomes and different taxes according to Finance Act. Of course, whichever year you're dealing, we can look around, which we can further explore, and we can download. I'll share with you as well, latest one. So employment income, bank, building society, property income, and all this, and financially as when it's run for the tax purposes. Yeah, the tax year. Okay, you can stop me, please. If any question particularly, you can ask. We can go through. Yes, you already know tax allowance. This is quite old slide, but it's 12,570 is the new, which that's because every year we can look around the personal allowance, which is working in a tax is quite crucial. Yes, so we can look around tax calculation, total non-saving, saving income, the personal allowance, exempt. Yeah, so these all we need to be carry on looking according to the Finance Act. Yes? So of course, saving incomes. So if you want, particularly, we can look around those issues, but in generic, so we can look around how we can do the tax calculation. Of course, we can look around tax variance and tax avoidance, yeah, and tax planning. Of course, tax planning is illegal to ensure use and made all the available tax relief, yeah. Of course, we can look around the carry forward, back forward, and those the losses and tax planning, which we can look around, yeah. Tax avoidance currently legally to make use of loopholes in the tax legislation to reduce the tax liability is can be, but the tax variance is illegal to deliberately mislead, authorities to reduce the tax liability, like, making intentionally tax in VAT return, missing the figures, and then we rectifying in the next VAT return because we can look around, but we can, yes, so deliberately doing things or hiding things can be, is come under the fraud. Allowable and disallowable expenses, so those we can look around the gift, not costing more than 50 pound per donation, depends, yes, donations and all, redundancy payments, yes, trade and excess of the amount, which we can look around the limits, and leasing cost, those can be in the company's point of view disallowed, and the payments we can look for that in according to. Okay, allowable are disallowable fines and penalties not applicable to companies. Yes, implies at the moment, of course, a lot of legislation change toward the property incomes and things because we used to claim. Now the companies can, individual can't. That's the big. That's why the people are moving towards more companies, properties transferring. So private expenses, trades, capital expenses, entertainment, legal fees, and all, which we can look around each, under the separate category according to the Finance Act when we deal with the clients. Okay, so we have 1.1 assessment criteria because we are doing LO1, which is further divided into 1.1, 1.2, 1.3. So we can look around the income and income tax liability related to overseas aspect. If you work abroad temporarily and you will need to be considered a tax position in the UK, of course, we need to look around the domicile. We need to look around yes, residency rules, of course, if you're living 180 days or more abroad, so whatever impact will be. Yeah? So these we need to be look around. So full-time basis, whole one of the complete years, strict, conditions, we can look around the fewer than 31 UK work day during the tax years. We can look around the paragraph of 2.3 of HMRC booklet. Yes, that's provide the further guidance on those issues. But the resident and not resident of the residency, of course, so tax need to be declared accordingly, and we can look around. Okay, so we can look around pay as you earn elements within overseas as well as the UK. Yes, so how we can make adjustments in the tax. Okay, so example, please. Can we look, we included few examples in which is good to look around, like, in this case, incorporated overseas, although the director is based in the UK, hold their, yes, board meeting in the UK. We can look around the company that are incorporated overseas and only treated as being resident in the UK if they are a central management and control exercise in the UK. That's that's why the company is moving head office controls and all, so that the tax implication, like, a lot of companies move to Ireland because the tax rules and the tax rate is quite less, 10 to 15%. But in the UK is 19% corporation tax is being resident in the UK. Yes. So since the director is UK based and hold the board meeting in the UK would indicate in this case, the manage and control from the UK. Therefore, it is resident in the UK. The director is based on the overseas to hold their broad meeting overseas, and the company would probably be treated as a resident overseas since the central management and control exercise outside the UK. So these can be issues which we need to please. If you want to be further enhance these, I included the link of ACCA these example which we can use to look around further these scenarios. So when we'll do assignments, so we can include some of them to look around these. So yes, then we have again is a overseas dividend. We have withholding tax. Yes, withheld dividend. The rate is 15% in the various limited owns 50 or less percent voting rights. We know the parent, subsidiary, and associate elements. Do we know? Yes. What is the parent company? If you own 100%, if you own 50% or more of other companies, so that's your subsidiary. Yes. So if you own it for 50% or more than 49, yeah. So we can call subsidiary. Yes, if you own it 20 to 49%, we can look around associate. And if you have less than 20% shares, we call simple investment. Yeah. So that's which we can look around. Yes, overseas branches and associate elements. So tax purposes, we can look around who control it. Yeah. So these examples we can. Okay. So if it's a dividend, yes. So like is a 50% or less voting right overseas companies, and then overseas dividend will be exempt from the UK corporation tax, but included the frank investment income and others. So we've been given the examples here. We included the link for further, to look these examples. Any question from anyone? We all okay? Yes, please. If any question you can ask. Capital allowance, of course, we can look around. It's a man pool, special pool, or short life, or private use assets. Yes. And we have to treat the assets accordingly. We can look around annual investment. Of course, it's carry on changing every year. This is slightly for which we can look around this year as well, which I'll give you next, lesson. The latest rate, we'll embed it further, and we'll discuss, those as well. Huh? Okay, so written down allowance, you already know is man pool is 18% and special pool if asset belong to. So then again, it's quite good to look around which category your asset is falls. Of course, with a list of assets, and then we need to be look around special pools, those assets according to the HMRC rules. Okay, so private use asset, don't pool the private use asset and show full value of the asset allowance in the column, which we look, few example numericals to look around these, then we can make adjustment arise according to which can be. Okay, short life asset and elections can be made, depuls, asset, and we can look around the asset must be disposed of in 8 years of the end of the period of acquisition. When we acquire, we can look around the planning and depuling of their assets, which we can, it's not really we keep into man pool. And of course we can, because we can't really claim it's for certain period of time, certain asset we can claim are written down now. So okay. Taxable total profit, please. When we need to calculate a little pro forma taxable trading profit, how much we have, interest, other income, property income, chargeable gains. Yes, and then total profit less, qualify charity donations. If we give, those we can claim, and we can look around and how much is the tax, which we're supposed to pay. And we can calculate, which we look, some example. Interest, yes, income from the non-trading source minus the interest payable on the trading loans. If we have, we can make adjustments. Property, business income, all the property income be treated as a single source of income and calculate in the same way as the trading profit. Okay, so we can look around accounting periods. Yes, the first 12 months from the first accounting period and the remaining months, from the second accounting period, as it can be fall into two taxation period, and we can look around then two different, the finance act can be and long period of accounts, if the period is exceed the 12-month, divide the profit between two between the accounting period, which we can, and we can look around the laws accordingly, which is always good to look around according to the finance sector. Okay, we can look around the rates. Yes, the rates of the corporation tax are set financial years. Yes, we know the years start and it was 20, now is reduced to the 19. Okay, the basis of even was 25% before as well. It's 30 used to be. It's a lot of the things change now in terms of the taxation. So we can look around according to. Okay, the special basis of the rules which we can look around the date commence 5th. Yes, during that 12 months and the 12 months accounting period if 3 years and so on. So we can proportionate some the income according to the accounting years which we need to look around. Okay, overlap profit. Yes, any profit taxed twice in the operating years are called overlap profit. Yes, overlap profit may be revealed on within the final year of overlap profit are deducted from the final year of profit. And assessment focus, yes, which we can check the calculation and we can switch profit, we can adjust it accordingly. Of course, you're not doing exams, so we're not worried about in terma, but only we need to make sure we'll add some example when we'll do the assignment discussion, and we'll give you some sample assignment accordingly and some which examples we can include. So we can look around when we have, the taxation adjustment, when we cease business, or we need to be look around, overlap profit elements, and we make adjustment accordingly. And this is one of the very old example, but it's look around that give us idea how we can, adjust it, which we can look around in when we'll do some examples, which will embed. Okay. Change of accounting dates. Yes, which we can year to change. Of course, maybe created a new overlap from years before and relief, which we can be, so which we can look accordingly. Okay. NI, national insurance, of course, is a class 4 or 2, whichever, and you need to be make sure will, because of course now is NI is changed to 13% approximate, and we need to be make adjustment accordingly. Yes, if we are self-employed, employed, and class. So yes, always trading losses, we can look around how we can carry forward if we have a loss, not otherwise revealed, and deduct first available profit. In if you have a loss previously 5 years before, you can carry on. When you have a profit in that years, you can deduct those losses to make your tax bill, and tax planning is illegal. Yes, which we can, and we can look around these, and relief. Yes, loss is deducted from the total income and tax, and loss and preceding tax years, which we can loss can be set against again the years of the yes of the preceding, which we can loss must be set against the income of the relevant year first. And we can look around like if you have this year you have a profit and the previous years you have a loss, so we can set the loss of the most old one, and then which we can carry on forwarding the losses, so we can, because otherwise the 5 years period which we can't claim it, that's really we need to make sure we'll do accordingly. Okay, trading losses, the company trading losses may be set against the profit and the same accounting period set against profit of the previous 12 months, and carry forward set again the first available profit in the same trade. Yes, before we qualifying the charitable donations, yes, remain we can look around those, of course we can claim those as well. Okay, so of course reliefs and all, we can look around as we discussed. Tax planning is illegal, so we can look around tax planning purposes, and then within certain depends, the gain is relief is in certain accounting period. Yeah. Yes, losses again set the current or the future gains and never income and cannot be carried back. Yes, we can carry forward. Okay, so of course we can use the pro forma of whichever years we are doing. Yes. So let's say, we can look around the trading profit. We have these and we have a less losses, yes, brought forward, which we can look around, and other, income and net chargeable gain, then total profit, less loss, the relief of those years, which we can look around first, and then we can climb to the following. So we don't want to waste it. Yes. So tax planning is illegal, which we need to be carry on looking which one you want to be claimed, because as accountant, we need to be look the planning side of it. So earlier relief, cash flow advantage can be, yes, tax saving offset, again, the profit in this is of course is all which we can look around in those particular years, which year we are dealing with the accounts, yes, and the reliefs we can claim. Okay, the property losses against income before we can look around the relief, the current period and excess, losses carry forward again the total income. And we can look around the capital losses, yes, automatically set again the current year's gain, yes, excess, losses carry forward again the first available future gain when we have. And overall, it's the same. So chargeable percent disposal of assets. So the chargeable disposal, yes, this include the sales and the gift and deductions of the asset, which we can look around the chargeable percent, the companies and individual. And chargeable assets is most assets are the chargeable. Exempt asset include the cars and some of the chattels, which we can look around, especially those categories in the certain areas. Okay, so we can look around the gain when we have how much proceed, how much cost to you, and how much net gain you have, which we can, and then we can look around according to the act, which we can calculate. Okay, we'll go through some more example in the next, lesson, where we can look at an actual example of current years. So rate is 20%, 10%, and so on. So we need to be always look around, yes, corporation tax, annual exempt, yes, and so on. So which we need to be look around accordingly in those years. Okay, deduct all allowable capital losses, the gain which we can look around and calculate. Yes, if we have indexation of the shares, if we have a gain through, so those we can look around as well. And the shares is also, of course, the values and all we need to be look around. Okay, we can look around the gain and the losses for the companies and indexation. Yes, we can expenditures multiple by indexation factors run from the date of acquisition date, disposal and the cost what we have, and run from the date incurred and the date of disposal enhance, so we can indexation given to you in assessment, and the losses, of course you're not doing assessment, but we can include some example. Now, part of disposal, yes, so maybe the asset you look around the disposal, so we have to look around, we have to use the formula A divided by A plus B. So is the proceed from the past sold, and B is the market value, the part retained. Yes, so that's which we use the formula to look around the proceed. We have a proceed, but less if we have any cost of disposal, we can minus less 18,000 was the proceed, 18,000 plus how much was the total asset was estimated value, and then we can minus it, and we can say the chargeable gain net we have which is 7,000. So this way we can transfer, and we have a special rules for these. We need to be look around under each particular finance sector. A chattel is the item of tangible movable properties, the painting or gain on the chattel sold, gross proceed less the vesting chattels exempt, which we can look around, and maximum gain on the chattel sold more than 6,000, where the cost is less than 6,000, so we can proportion, yes, gross proceed minus your 6,000. We have more, we can proportion. So losses of the chattel sold, which we can restricted, and assuming the gross proceed to be 6,000. Okay, so please, each category, of course, we can look around the market value of the assets, and we can make adjustment accordingly, and exemption criteria in each section. Okay, spouse and the civil partners. Yes, the disposal between the spouse and the civil partner don't give the rise to the gain or the losses. Yes. So like here we have example, bought asset in 20,000 and give to his wife Julie when the market value was 30,000. So deemed proceed is 20,000. Let's see, the cost is 20,000, no gain or the loss. The Julie based on the cost for the future disposal is 20,000. So that can be sometime we need to look around under each finance act. Okay, occasions of the chart, deaths, gift within the 7 years, we can look around other lifetime gifts, which we can according to. Okay, so we have lifetime gift. Yes, any gift which is not exempt. Man, example, of course you're not doing exam, you just we can include some examples to look around, these which we'll go through when we'll do the assignment discussion, so we can pick some examples to go through accordingly. Death rate 7 years, more than 7 years, lifetime gift. Yes, so we have the which is inherent tax. We know 325,000 is the limit. Transfer value, special exemptions, yeah, tax calculation, chargeable. Of course, nowadays, when we're dealing with the tax, the software automatically updates, the things, and just a matter of putting, but we have the rates, and some interpretation of the taxation and the tax planning purposes. We should have the knowledge about these, deeply when we're dealing with the clients. Huh? So nil rate band, 300, previous was 312, now we have 320 to 340. Okay, so we can look around if a 7 years rule apply, if, and the nil rate band is in this case, yeah, we can look around if that falls. Huh? So we've been given the rules here. Years before the death is 3, but less than 4. Reduction in relief, yes, can be if 4 years less than 5, 40%. If 5 but less than 6 is a 60%. If it's more 7 years more, 80% in lifetime paid. We can look around capital lifetime tax, what is being, and property being transferred and all. So we can look around the tax and the taxable amounts. Yes, and tipper relief and chargeable gains accordingly as the scenario. Okay, so lifetime gifts, annual exemption, 3,000 per year tax year, carry forward for 1 year only, use the current before brought forward, small gift. If you're giving gift, yes, then we also 250, yes, total gift per donee. We can look around marriage exemption, 5,000 per parent. Yes, if the parent giving, and per grandparents and party to marriage, yes, and 1,000 to others, yes, and number of we can look around the normal expenditures out of the income which we can, and those which we need to look around accordingly. Yes, freehold properties are replacement, adjustments are mortgage, and the lifetime. So these the issues can be which we look each individual scenario, and we need to be look around 70 years rules. We look around it's a lifetime, yes, what we been claimed, and when the property is being transferred and so on in the under the inherent tax. So we in our assignment we can pick one of scenario which we can use it, and that's which we can look around when we'll go through our assignment discussion. Use available exemption and relief. Yes, a gift asset during the lifetime, donor may be survive 7 years, tipper relief survive 3 years, and annual exemption available, and freeze value of the gift, which we can look around accordingly. Transfer of deceased, spouse unused if they nil rate. Yes, band depends which band your falls. So we can look around these according to. Okay, so we included some example if you want to look around the merit criteria to work. So we can look around, evaluate the income and income tax liabilities in relation to the trust, if you want to work towards. So we can look around those example, and assess the stamp taxes and all others. Yes, so if you want to look around the distinction criteria, so we can look around some examples too. We can look around the stamp and stamp duties and things. Okay, so of course if we look in LO1, this is just, we need to look around some basic rules, according to whichever year we are dealing with the tax, because we will do assignments. So we'll pick examples in our second lesson, and we'll look, those accordingly, and we'll link to our assignment, which learning outcome we can match to according to, yes. So it's good to, if you want to, please just look under the Finance Act 2022, 23 or 23, 24 release. So what we can, so I can share with you, just 1 second if I can. Any question, please? Hello, can you hear me?
Yeah, we can. No questions.
No questions. Okay. Because, tax is, of course, maybe it's a question can be come on. Yes, we know thoroughly. We can create some templates. We can do some numericals. But of course, the scenario can be totally different. Okay. So what I'll do in the next lesson, I will include some numerical element to look around, few scenarios to get the basic understanding. But this can be in various, depends case to case. Huh? So what you can do, please, before next lesson, if we can look around the Finance Act 22, 23, yes, and we can look around the inherent tax rates, yes, and we can look around property incomes and overseas elements, and we'll look, some numerical then. Okay.
Okay.
Brilliant. Thanks for attending today's session. If you have a question, we can go through. If no question, I'll add, some examples for you, numerical side, and we'll discuss, in our LO2 contextualize to LO1 as well. Okay, I'll speak.
Hello.
Yeah, it's like it's ended.
We can. Thank you. Have a lovely weekend, and we'll see you next week. Hello. Yes, please.
Yeah, we couldn't hear you.
Hello. Yes, can you hear me?
You. Yeah, now it's better. We couldn't hear you
Oh.
for I think 1 minute or so.
Okay,
So
brilliant.
just to recap, you're saying we should refer to the Finance Act 2023 and specifically look at inheritance tax rate and what else?
Okay, brilliant. So what we'll do, in the next next lesson, I will include, some numerical elements, and when we'll do in our LO2, we can contextualize, and when we'll do assignments, we'll include examples, huh? Because your only is the assignment, so we need to pick some examples which we can include in our, yes.
That's fine. Okay.
Okay, thanks for attending today's session, and we'll speak you during our next lesson, yes, and we'll speak you accordingly. Yeah? Thank you.
Thank you.
Please,
All right, cheers. Cheers, bye.
if any question, you have my email, yes, anjum@ukversity.co.uk, and I'll get back to you as soon as possible. Thank you.
Thanks.
Thanks. Bye-bye.
Bye.